Hi everyone, this is Sophie from InvestSMART, and joining me today is Portfolio Manager Nathan Bell. Nathan is going to provide an update on our equity growth and equity income portfolios, and also discuss the US residential property market and why the Australian share market looks more attractive than the headlines might suggest. Nathan's presentation will run for around 20 to 30 minutes, and then we'll have time to answer any questions you may have. Okay, Nathan, over to you.
So we're looking at essentially focusing on the December quarter, which was the second worst December for the performance, I think, of the US share market, at least, of all time. And it wasn't a great quarter either. The worst quarter in Australia, I think, since the GFC. So I hope that didn't have anything to do with me coming back to InvestSMART, Intelligent Investor. But probably if there was anything frustrating about it, obviously clients like to see the returns going up, but I'm more focused on the long-term returns rather than what happens in a quarter. But the Australian market compared to the rest of the world has actually been quite rational. So if we look around the world, you're seeing very cheap valuations in certain places like China and other emerging markets. But in Australia, the expensive stocks have remained expensive. And if I look at what looks cheap, it really is the sort of low-quality stuff that you really don't want to be filling up a portfolio with. So for now, it's more of a matter of patience, but on the whole, I'm happy with the stocks we've been adding to the portfolio. As always, we just like to be adding more new and unique ideas. Sorry, Sophie, I can't get the slides to go across. There we go. Okay, so whenever I do these presentations, I always like to just have a couple of basic slides that I'll have in front of all my presentations to remind people what it is we're trying to do. And a common question you get asked as a fund manager is, what is your edge in the share market? And these are pretty basic things, but when you add them all together, they actually give you a really large edge over time. So we're long-term, we're patient, we're contrarian when we need to be, we're humble. At the same time, we're concentrated, independent. But in being humble, we also need to back our judgment when the time comes. And it's almost a sense of arrogance, as Seth Klarman described it, when you're buying a stock that the rest of the market's willing to sell. I've got a consistent process, which we've had for 15 or 20 years, and we're targeting the best returns possible, not the biggest fund possible. And I think something that we haven't really used to our advantage as much as we should have over the life of this fund is we're very flexible by market capitalisation. We can't get into the micro caps, which is why we have a small cap fund, but we can get those smaller companies with hundreds of millions of dollars of market value that are really good businesses who have well-defined markets, have good balance sheets, preferably they've got owner-operators running them. And the beauty of having essentially what we call an all-cap fund is that if you're a small-cap fund and you find a great business, let's say it was ARB Corporation in the past, when it was a $200, $300 or $400 million business, a lot of small-cap funds have to sell that stock when it gets to a market cap, more towards $1 billion. The beauty for us is when we find those great businesses that we want to stick with, we can actually continue to hold them. So I think that's a huge edge for us, but it hasn't necessarily been used the best over the past few years, but it's something that I'm definitely focused on for the future. This is where we tend to find value. We find value in high-quality businesses that are on the nose for some reason. So that's our large discount to intrinsic value, which gives us our margin of safety. We want those long growth runways because the best way to build value for you is in a tax-free environment. So we want those companies to continue to grow their earnings quickly over time, and for us just to stay out of the way and let them do their business. And again, always looking for high insider ownership. Doesn't guarantee anything, as anyone who's owned Harvey Norman shares will tell you, but it's really important to have alignment between management who are thinking long-term in the same way we're thinking about our portfolios for the very long term. And I think a few areas that still statistically are reliable, that create opportunities to outperform the market, or another way of putting it is where we find the market is least efficient, is when you have a new CEO taking over a business, often recapitalisation situations where shareholders are very disappointed with what's happened with the business and they just get frustrated and sell out. And the business gets fixed for the balance sheet and tends to have a new CEO at the same time. And I actually found some evidence during the week that there is some research that shows that when the CEO does change after a period of really bad performance, statistically it can actually show that that change can be the start of a period of really good performance. Spin-offs, which are a typical, quite an American thing, but we're seeing more of those in Australia, and Trade Me, which is a stock that's worked out really well for us recently. That was a spin-off out of the old Fairfax business, and Hidden Assets. So these are qualities about a business that aren't well appreciated and don't necessarily show up when people are searching the market for, say, high return on equity or high growth. These are things that don't show up in those sorts of screens. So first, I thought I'd just give you the 30,000-foot view of markets and the economy more generally. What we've got at the moment is a very slowly deflating global credit bubble. So if you look at debt levels across the globe, they are far, far higher than they were at the peak of the GFC. So that should instill a little bit of fear in you. And the central banks, what they're trying to orchestrate is taking liquidity out of the markets without crunching the markets or the economies at the same time. And we saw Jerome Powell, who's the Fed head in the US, basically just turned on a dime over the last 3 months, and the market was generally expecting another 2 or 3 quarter percentage point rises in US interest rates, and he's just now said that we're going to sit there and have a look. So I don't know whether that means the Fed's on hold now in the US, and we've seen stock markets come back a little bit through January, which is really part of that. We'll soon see, but I think that's telling you that the problems that everyone expected was going to happen when you had quantitative tightening and higher interest rates have really happened much quicker than anyone thought. And I think even the central bankers would have thought they had higher interest rate levels before they put the brake on. So I think that's part of the reason why the stock market's been okay in the new year. The US consumer is in rude health, got record unemployment, even though I think there's a lot of people in the US who would like to have work, they just can't find it, which don't get included in those statistics. So I'm not expecting an imminent US recession, and there's no actual reason why you couldn't have reasonable US growth. When I say reasonable, not the 3% annualised we've had recently, but if you could just tick along at 1.5% or 2% over the next 3 or 4 years, I think the governments and the central bankers would be very happy with that. I had a piece in the quarterly that explained why I'm very bullish on US residential building over the next 5 to 10 years, and we'll talk about that coming up. I think there's actually a lot of value in emerging markets, although I find it very hard to find exposure to that through Australian companies, which most of their overseas business tends to be in the US, which is fine. And I think the Australian share market is actually around about fair value, maybe slightly overs after the recent run-up in the new year. But I think it's much better position than, say, the US market. And that's mainly because we've had a huge run-up in the US share market since the GFC, and we just really haven't experienced that in Australia. That said, I think if you're looking at those really high-quality, fast-growing names, then that stuff's obviously priced for perfection, so we have to be a bit patient with those names. If you're looking for worrying signs, and there's plenty out there, obviously property prices is the big one that are falling in Australia, and they seem to have sped up a little bit recently. That said, we've got JB Hi-Fi's results this morning, and while they weren't brilliant, it actually showed in the last 6 months that earnings had ticked along just fine. The outlook was for fairly flat earnings growth, if you can call it that. But I think if you're in a situation where you've got property prices falling anywhere from 5 to 10% in a year, and you're a retailer that is directly exposed to that, if you can have flat earnings growth over the next 12 months, I actually thought that would be a pretty good result. Debt levels are the big issue in Australia. They're going to have to come down one way or the other. And if it comes down slowly over the next 4 or 5 years, I think that's exactly what the RBA would be hoping for. And I don't think it's recessions that people are necessarily afraid of. I think it's more financial crises where you get share prices falling by 30 or 40% across the board, rather than what might occur with a somewhat shallow recession where share prices might only fall from, say, 15 or 20%. The other big thing I think that's really important, and it ties into the property prices and the debt levels, is actually the complete capitulation in Australia's savings rates. I'm absolutely not surprised with this, even though we've got very low interest rates. We've got a huge amount of borrowing out there, and now you're starting to see people struggling to repay the mortgage, and it's not just mortgage, it's the debt they've taken out on investment properties. And although credit growth has just been ticking along for the banks, you've probably seen the charts where most of that growth has come from owner-occupiers. So people aren't really borrowing any more money now to buy investment properties, which is hardly surprising when you've seen some of the new policies that Labor are likely to bring in, assuming they get voted in. And part of that is why the savings rates collapsed, because investors have completely pulled out of buying new properties as well. There's been lots of profit downgrades at home and abroad, so I often get asked, how is reporting season going? But actually, if you're going to reduce profit expectations, you usually do that in November, or some even as late as December. And so when you actually come into reporting season, people will say, oh, well, actually, it's in line, but those earnings growth might actually be in line with already hosed down expectations, and that's what we're seeing. So there's actually been a lot more downgrades around the world than there has been upgrades. And the question is being asked is inflation or deflation. I've got a couple of charts to talk about that. I don't actually know what the answer is, but I still think the big fear out there is deflation. But as we've seen through history, markets do tend to surprise. So this is the savings ratio. You can see it's come right down, particularly over the last 3 or 4 years. It's just been getting worse, and it hasn't actually gone below zero yet. And the last time we did that was more around 2006. So that was back before the GFC, so that was a fairly long time ago. But to me, it is an ominous sign that Australia is tapped out as far as borrowing more money. We saw the result from Commonwealth Bank recently. It was fine. Bad debts remain, I think it was almost at a record low, which is telling you there's no reason to be panicking out there in the property market yet. But in terms of what you can expect from property prices and credit growth, which is really what drives economies and the bank's earnings, I think that's going to remain pretty morbid for a while. But the question really is credit growth going to collapse in terms of are we going to see a whole bunch of bad debts? And that's what people are really worried about, and that's what you saw the government telling the banks to lend, which was pretty ironic after the last 5 or 6 years of rapid credit growth. And obviously a lot of lending to people who shouldn't have had those big loans. But I think this savings ratio is really something to keep an eye on, because it's a little bit like credit cards in the banking business. Although bad debts for mortgages were extremely low, there was a bit of an uptick in credit card debt, and to me that's telling me that the marginal borrower in Australia is tapped out. More broadly on that savings ratio, it really does tie into earnings for a lot of businesses that are tied to general economic growth, so housing and whatnot, retailers. If you haven't got that marginal person buying more stuff or borrowing money to buy more stuff for new homes, then you can't expect profits to grow very quickly, and you can't expect margins to hold up either. And this is a really important slide, I think, here. This is US wage inflation. And for really the first time in almost a decade, you're starting to see a bit of decent wage growth in the US. And you can see on the top part of that chart is the unemployment rate that's come right down to 4.1%. I think it's actually 3.9 now. So as the employment market's got tighter, wage growth is going up. So it's harder to find employees to grow your business, and that's going to impact profit margins. And Jeremy Grantham was always fond of saying that profit margins are the most, would come back to the average more quickly than just about any other statistic you look at. And in the US particularly, we've got almost record high share prices based on record high earnings growth and record profit margins. So that can really only go one way over time. So you just got to be very careful about the expectations you build into share prices from here. This is a chart I looked at. This is really why I'm bullish on the US housing market. What this is telling you, you can see that really sharp line that falls next to the red line, and that's essentially the fall in residential investment as a proportion of the GDP or the economy. And you can see how it basically went to a record pre-GFC, and then it just absolutely collapsed. Now, what's more important from where we're sitting today is that you can see, even though we're 9 years on, almost a decade on since the GFC, residential building as a proportion of the economy in the US has only got back to the average. And if you look at the number of homes, you can look at the next chart, which is US existing houses for sale as a percentage of the US population. It's basically at a record low going back 30 or 40 years. So what these statistics are telling you is that the US needs to build more homes, but there's a real lull in that market at the moment, and people have started to wondering, are US consumers tapped out? I don't think that's the situation. I think just a lot of property prices in the most popular areas have gone up. If you look at the home builders, for example, NVR, which I haven't mentioned, is a US company. It's one I really like if you're interested in investing abroad. It's a home builder. It tends to sell its average land and home package for about $380,000 US. So they're not obviously building these homes in the middle of San Francisco or New York. And I think over time what you're going to see is millennials which are now starting to get to that age on average where they're having kids and buying an extra car and all these sorts of things. That's going to really increase over the next 5 or 10 years. So while there's a bit of a lull in the US housing market, which is affecting a bunch of companies like James Hardie in Australia, for example, I think that's just a lull, and I think the next 10 years is a good reason to have exposure to that, and we do through companies like Reece and Reliance Worldwide. You can see in this chart here, this is the millennial population working its way through. So this is a bit like the pig and the python analogy. But if you look to the arrows on the right-hand side, what it's saying is in the years of 2019, 2020, which is where we're coming into now, you're starting to really see the growth of that millennial population come through. And you can see the enormous growth we're expecting over the next 10 years. And Warren Buffett's quite fond of saying that he doesn't think the future population of the US will behave any different to past populations in terms of having babies, raising families, buying extra cars and living in the suburbs. Obviously, a lot more people these days tend to want to live in condominiums in the busy cities, but you're starting to see that there is plenty of anecdotal evidence that people are moving away from those cities as they're just becoming either priced out or just impossible to live in because it's just so hard to get the transport and other services because they're so busy. So I think this is the key reason. I wrote this up in the quarterly. If you're looking for a bit more of an explanation for it, please have a read of that. So just in terms of where we are in the summary of the portfolios, I think right now this is a situation where we're putting risk before return. I don't think this is the type of situation where you want to be sticking your neck out buying, for example, low quality, statistically cheap stocks, because we've seen a number of them go broke recently, and they're not the sort of company, high quality companies we tend to want to own anyway. Usually this is likely to mean short-term underperformance, which is absolutely fine with me. What's important is that we keep the risks low, and when the prices finally come back our way and it's time to load up on maybe some of the lower quality or cheaper stuff, then we'll do that. And that's really the lesson we learned at Intelligent Investor, and anyone should have learned from the period through the GEC, is sticking to quality absolutely paid dividends. And they're the first to recover outside of a recession or a crisis, but it's just far less stressful owning those businesses. And when the time comes where maybe we see an RHG or something like that, just a unique stock that is really underpriced, but in the crosshairs of whatever the economic problems tend to be at the time, then we'll be looking for those opportunities. But I just don't think that's the time we're at right now. This is a time we want to be focused on quality and not doing anything silly. Our portfolios are still extremely different from the index, even though the income portfolio in particular probably looks the most like the index it ever has. My guess is it's probably around 20% in common, given there's a bit of a decent helping at Commonwealth Bank and Westpac and BHP and Woodside, some of the bigger companies on the market. But I don't think this will last, and I'm trying to get some more unique, sort of more esoteric, intelligent investor type stocks in there as well. We're well positioned for returns of capital. I think you might see across the course of the years there's a bit of a race to lower the franking balances in some of the companies, as it looks more likely that Labor will get in and potentially change the franking laws. So Flight Centre and BHP are a couple of those stocks that have plenty of dividends they can pay out. We're trying to get some overseas diversification, and I think we've been probably more successful with the growth portfolio than the income portfolio, and that's just mainly because the businesses more exposed overseas tend to be a lower dividend paying companies. Just about all the companies in our portfolio have excellent balance sheets, so I have no problems with that whatsoever. The cash in the portfolios was reducing. It sort of ticked up a little bit with a couple of sales recently, but the cash is down to single digits. So what that means is we're now going to have to be much more selective about the stocks we own. It's not a case of just adding stocks to the portfolio. And this is actually a good thing. The best portfolio you can have is when you've got more ideas than money. And so what that does is raise the bar for a new stock getting into the portfolio, and therefore, theoretically at least, should be increasing the potential return of the portfolio. Turnover was my theme for the January update. If you haven't read that, please do so. It's now getting back to normal. The turnover was far higher for the growth portfolio than it was for the income portfolio, and that's just mainly because I had a bunch of ideas that I brought with me from the past that I wanted to get into the growth portfolio, and that's mainly happened now. So now it's really just nose to the grindstone, and you'll see the turnover has already gone back to normal. And I think this is just the key lesson for anyone, whether it's a fund manager or if you're managing your own money, is now the time just to get the simple things right. Don't over-diversify, but also don't have too much concentration in areas like banking or having all your eggs in one basket, whether that's a portfolio full of banks, but you're also very exposed to property. Now's the time just to get those simple things right, and therefore whatever happens from here, whether we have a recession or whether things don't turn out to be anywhere near as bad as what the headlines might suggest, you can go to sleep at night not having to worry about anything. I've tried to go through here and list every single sale from the growth and income portfolio since I came back, and you can see there's quite a few stocks there. I won't go through all the stocks. I've written about them all through the quarterly or monthly updates, but the main thing to take out of it is if you just compare that list and then compare it to the portfolio buys, and again, most of the buys are in the growth portfolio compared to the income portfolio. That's just because I've been able to find more interesting companies that don't pay dividends. I'd love to get some more of these companies into the income portfolio, but we promised to deliver a grossed up yield of 5%, so it does limit the number of these stocks I can get in. But to me, and again, I may be wrong in time, but to me this just looks like a far more interesting and better group for the portfolio. I don't think we've taken any extra risk in the portfolio by adding these stocks compared to the ones we've sold, but a number of these stocks have far higher potential returns over the next 5 to 10 years than what that existing group did. So I'm far more excited about the portfolios now compared to when I joined, and the hard part now is just trying to add more of these names. So I'm actually hopeful there's some more falls in property prices, because what I really want is for some of that pressure on the property market to put more pressure on the stock market. And if we can get some more dispersion or a bit more panic in the stock market, then that means we can really load up on some of these faster growing businesses over time. So the short-term price for that is lower returns, but the long-term value from that is a huge advantage, and that is getting the portfolios really reset in higher returning businesses. But we can only do that when the valuations let us do that. I had this slide. I was doing a different presentation, and I was just trying to explain the intelligent investor process and through experience what I find works over time. And I thought one of the best ways sometimes to do that is to flip it on its head and actually tell people or show people what doesn't work. I think this is particularly important when you're at the end of an economic cycle and potentially at a turning point. And so these were just a bunch of things that I thought of, and I could have thought of a lot more. But if you're managing your own money and you're looking at different stocks, this is a bit of a checklist of what you don't want to be looking for. Sometimes when you see management or a founder depart a business, that's generally a warning sign. Sometimes you see some great transitions in business where potentially a family member or someone else who's been in the business for a very long time can take over from a well-worn CEO, and that can be great. But sometimes when you see those managers leave an industry, often I think it says something about the industry that's either very mature or the return expectations aren't great, and the manager doesn't want to be there to go through the next cycle. So that's something I tend to focus on. Insider selling, if there was only one thing, one piece of information that I could make investment decisions about, it would be insider buying and selling. We don't always know why insiders are selling, but I have noticed as the market's gone up in some of those growth names, there's been a bit more of insider selling recently. Jumbo Interactive was a good example of that, even though the founder still owns a lot of shares there. Technological obsolescence, I think this is something that people are heightenedly aware of anyway these days, but in the old days there was a well-worn value investor strategy, which has been able to buy some companies that were essentially in runoff, but they were so cheap that you were able to buy them cheap, and as the cash flows came in from the runoff, you were still able to make money. But that's really changed in the last 5 or 6 years. The technology these days is changing so quickly that those runoff don't tend to happen over 5 or 6 years. It tends to happen in 1 or 2 years. So I think that's very dangerous. You really want to be on the right side of technology. Look for businesses that are heavily shorted, because if they are heavily shorted, then you can guarantee these guys have done a lot of work on these companies. You need to be very sure about why you're buying these businesses. That doesn't necessarily mean the guys on the short side are always right. I find it amusing sometimes that you see some of the highest quality businesses out there getting shorted, which to me just seems so stressful, because the good businesses tend to continue on to be good businesses. But if you do see a heavily shorts, and that stuff's published fairly well widely these days, so it's easy to find those numbers, and just make sure you try and understand why they're shorting the business, so you've got the argument in favour of hanging on. Always frightened by complicated accounting, and if you see mention of overseas legal jurisdictions in the annual report, that's always something to be questionable. or question. Businesses that rely on short or risky contracts. I've seen a number of companies recently come under pressure because the contracts they had were very short and couldn't be renewed. But there are all sorts of types of risky contracts, sometimes in places you don't necessarily think about. If you think about Domino's or these sorts of companies, often have to pay royalty fees, and they can change. There was a SAI Global used to have a printing contract which looked like a really profitable business, but those things come up every 5 years or 6 or 7 years and have to be renegotiated. So often that can mean lower profits in the future. Be very careful about companies being heavily geared. Just because it has high debt doesn't mean you should automatically cross it off your list as a potential investment, but just be very careful and try and look for companies that if they do have that high gearing, one, they've got the revenue stability to support it, and hopefully that debt is really long-term debt and very spaced out. That was really what brought the real estate investment trusts, for example, down during the GFC. Most of the Australian properties, at least, performed really, really well, but the banks just said, you've got all this bank debt, it's all very short-term, we're getting worried about our own balance sheets, so we're going to make you raise capital to make your balance sheet safer. And so that bank debt, short-term bank debt, is really the worst type of debt you can have. The second last point there is look out for inflated earnings or companies with low reinvestment. It's easy to inflate earnings, and we're seeing a record at the moment, at least in the US, between GAAP earnings and non-GAAP earnings. So that's telling you those inflated earnings are at some sort of record as well. So if you see any company looking for alternate measures of profit, make sure you're skeptical. And also just look out for businesses, which I think the banks fall into this category, where they can pay out a lot of their profits, but they just don't have a lot of options to reinvest that money and grow earnings over the long term. So just be careful, because there's a lot of cyclical businesses out there that masquerade as growth companies during growth markets or when the economy's good, as it has been for a fairly long period now. And often what happens when the cycle turns, you realise actually they are really cyclical businesses, and you can end up overpaying. And the last one I thought was really important, and I think gets forgotten about, but it's an old stock market term. It's the 10% dividend yield rule. And the rule is the closer a dividend gets to 10%, the closer it gets to zero. So make sure if you're particularly looking for income, be very careful about companies with very high dividend yields, because it's most likely that they're going to get cut. And maybe the company's actually already announced that they expect to cut the dividend yield in future. So that's my short list of what doesn't work, or at least to be very careful about. So with that, we're happy to take questions, Sophie.
Yeah. Okay, so the first one is from George regarding the warning signs of the heavily shorted companies. Can a list of currently heavily shorted companies be found on the ASX website?
Hi, George. I'm not sure if it's on the ASX website, but I'll take a note and I'll mention it somewhere for you, because I know there's a couple of different websites that do have it. I just can't remember them off the top of my head, but I'll do that for you, and I'll let everybody know so they can have a look at that list. I think it's published on a weekly basis.
Perfect. Okay. Mitchell has asked, you've got Reece in the portfolio. How is their expansion into the US going? Most Aussie companies fail when expanding internationally.
Yeah, so this is a very important question, and there's, Reliance Worldwide also falls into this bracket. The one thing I like about both these companies making these very large acquisitions in the US is that they didn't actually borrow all the money to make those investments, which tells me that they really believe in these acquisitions and they're prepared to raise capital to do it, which reduces the risk. The absolute worst situation is as soon as you see the word transformational, you should run a mile. When you see a company make a transformational acquisition and they do it all with debt, and they put the whole business at risk when things don't work out. So that's what I like so far. In terms of the actual results, we haven't seen the results from this quarter yet, so it's very early days. But I think the hardest thing that's going to be for these, for both companies, is that it's not just about the businesses they bought, because the businesses actually look, from what I've read about, look like very fine businesses. The problem is trying to mix the cultures as well, which is going to take much, much longer. And that's certainly not something you're going to achieve in 6 months or 12 months. That's a thing you achieve over many years. But the fact that the insiders at both Reece and Reliance Worldwide have put their own money or added money to make these acquisitions makes me somewhat confident that they're not going to fall into the 70% of acquisitions that don't work out. but you've got that extra layer of support that they didn't borrow all the money to make the acquisitions, and that gives them time. So I'm not actually expecting the results to be great, just mainly because the US housing market is in a bit of a lull at the moment. But over time, I think these are excellent management teams and very good businesses.
Okay, great. Another question. Clydesdale Bank's share price increased a bit last week. What's the reasoning behind this?
So Clydesdale has probably been the worst stock that I've added to the portfolio. And I thought it was quite cheap when I bought it. It was trading around tangible book with plans or expectations to do double-digit return on tangible equity, which to me, particularly in a low interest rate environment, suggested it should trade on about 20% higher multiple at least. It's a very well-managed business. The management team is well renowned for reducing costs out of the business, which is what you really have to work on as a bank, particularly when your margins are under a bit of stress from low interest rates and slow housing market. But last week, the company came out and the expectation was that with its acquisition of Virgin Money, which essentially was the main reason why what amounted to a profit downgrade last year, the profit margins have been, expectations were cut, and that's really behind the sort of 35% fall in the share price. But they come out and said originally they expected by 2021 they would be able to save £120 million on the cost base annually, and they upgraded that to 150. So in a way, that's exactly what we'd expect of this management team, and we've got a small uptick in the share price, but it's really going to be what happens over the next few years in the business, and they can't just cut their costs and really make a success of this business. They need to do more than that. They need to merge two quite distinct brands. They need to rebrand the business. There's a lot of competition for home loans in the UK at the moment because the market's very slow, and we're seeing this in Australia as well. So you can actually see what's happening in the UK is what's going to be happening in Australia over the next few years as well. And when you get that turnover of loans slows down, it really does hurt the banks, and you start seeing more competition on price, which is not the place you want to be. But Clydesdale's share price, to me, just looks so low at around 0.7 times tangible book equity. If you look at the Commonwealth Bank, I think it's more like about 150 to 200% higher than that. And I just don't think that's a fair representation of the value that's in the Clydesdale business. But it's going to take a couple of years for that to come good. You can't just acquire a large bank and expect to be able to integrate that in 6 to 12 months. That's really a 12 to 36 month process. But we are long-term investors, and as long as those future returns we believe are compensating us for waiting that long, then that's one of our biggest advantages in the market, is that long-term perspective. Because once you start thinking about a business 3 to 5 years out, you really don't have a lot of competition to buy that stock. Most of the market is focused about the next 12 months, and the next 12 months look pretty boring or bad in some people's eyes. But I just think this is one of the few stocks in the portfolio that I think could double your returns over the next 3 to 4 years. Excellent management team, very cheap price. Dividends should be set to increase dramatically, even if the share price doesn't go up too much over the next few years, or earnings don't increase much, because their capital and position and balance sheet is in excellent condition. So even though we've seen a small increase in the share price, I think it's still very cheap.
Perfect. Thank you, Nathan. Another question, is Frontier's investments in EM's currency hedged?
No, it isn't. And this is a really good point. And you see the same thing with the real estate investment trusts. For example, during the GFC or pre-GFC, a lot of them went international, and you may remember some of the names that aren't around anymore, but Macquarie, Countrywide, and a few of these. The problem with trying to hedge the actual value of the assets in these types of businesses, it's just so expensive because the value of the assets is so big that they don't do it. And what they tend to do is, if there's distributions to be made, they do tend to hedge those, which makes the dividend or distribution more stable. Now, Frontier obviously doesn't pay any dividends, so it doesn't need to do that. But when you're investing in places like Pakistan, obviously the currency can move things around, and the currency has been weak. I think that's just one of a number of reasons why the Zameen business isn't being valued fairly, in my view, as part of the stable at Frontier. But there's another reason why you shouldn't worry too much about the currency, and that is because if Zameen works out the way similar businesses in other countries have worked out, then over, say, the next decade, that business alone could be worth 10 times what it is today. Now, even if the currency went down by another 30% or 40%, if you were to make 5, 6, 7 or 8 times your money, then you're not really going to care too much about the currency. And the one thing I do like about Pakistan is that I actually think it's a far better, more stable market than what you think. When we see it on TV, it tends to be that there's some really bad news, whether it's maybe terrorism or war or these types of things. But if you have a look at the Zameen website, and it's just like REA, go onto the realestate.com.au website and have a look at the apartment complexes for sale over there, which Zameen is actually making quite a good amount of money from at the moment by clipping the ticket on those sales. Those apartments look no different to what they do in Sydney or Melbourne or Queensland or anywhere else. And it actually shows you that the country itself actually has plenty of people there. There's plenty of money there. And this is a country of 195 million people. And even though there's a lot of, looking at GDP per capita, it is a very poor country. It is improving. And what we're seeing in India and similar other places is that once they get access to mobile phones and technology, the growth can be very quick. And I think that's going to be the case for Pakistan over the next 10 years. It's way behind other nations, but to me, that's the opportunity. And the fact that the Zameen business is only valued at around, I think it's 300 million US at the moment. And if you actually look at realestate.com.au, it's valued at around 10 billion Australian dollars. And Pakistan has 195 million people, where a lot of Pakistani people live in the UK, for example, and they tend to be a big part of who buy these homes back in their home country. So there's actually a lot of money coming from very rich nations, from very rich Pakistani people that don't actually live there. And again, I just think this is why Zameen over the next 10 years could be valued at a much, much higher price. And I think we might be quite surprised at just how far and fast that country comes along. But you always have to be very careful, because things can always slide quickly as well when politics aren't going the right way. But I just think Zameen's so cheap, and we've got 13 or 14 other companies in that business, in that portfolio, that hopefully over the next 10 years will become the future Zameens.
Great. Another question from George. Is your investment in Platinum Asset Management tied to your expectation that there is value in emerging markets? For example, Asia. Is Platinum the best way to invest in this theme? From George.
So spot on, George. That's definitely part of it. If you have a look at the returns from Platinum over the last 5 years, they're actually pretty ordinary, in the sense that they're just basically in lockstep with their benchmarks. And I think that's one reason why a lot of people have started giving up on Platinum, and a lot of other investors have found that performance has been better elsewhere. Let's say for Magellan, for example, where people understand the companies that they buy better. It's just a much simpler thing to invest in. They don't really understand the Chinese market, where Platinum has been very heavily exposed in the last 12 months, and it's been, I think, probably the worst performing share market in the world. So when I look at the performance of Platinum, I think there's a lot of optionality or future value in the investments they've made in the Chinese market. And you might have heard before, I actually think Chinese share market is one of the cheapest in the world at the moment, has some phenomenal opportunities in it. So I think absolutely Platinum's performance can get better. And generally that's when the funds or people's investments start coming back to fund managers, when their performance is good. So it's basically after the horse has bolted. So I think there's lots of value there. The other thing I like about Platinum as well is that it hasn't really come into play yet, but if we do go through a tough period where share prices are falling, then they'll get a lot more value out of their short book. And so I think that's an advantage that we don't have as long-only investors. So I think that combination, the fact that people have given up on Platinum, I've seen one sell-side analyst say that his target is $3.50, which who knows, there's been outflows recently and may well get there. But I think in times of crisis, Platinum's actually a really nice stock to hold, because it's around those crisis times that their performance tends to be the best. They've got cash-rich balance sheets. There's no problems there, and they pay out basically all their cash as a dividend. So it's not a large position in the portfolio, but I think people may have given up on this business a little bit too early, mainly because they're just thinking over the next 12 or 18 months rather than the next 3 or 4 years.
Okay, so still on Platinum, is Platinum offer more upside to investing in Asia than a direct ETF?
So the answer to that is yes, and the reason is because if you just buy a portfolio of stocks, then you're just going to get that portfolio of a very highly diversified return. If you buy the management company, then essentially you've got leverage on the performance fees of the business. So a good example is if you look at Magellan through the GFC, you were able to buy the management company. I think it was about $1 a share, and it was basically all cash. And the performance of the funds that Magellan has managed since then are somewhere around, I think, about 10 or 11% per annum since the GFC, or maybe a little bit higher, but lower than that recently. But if you actually look at the share price of the Magellan management stock, I think it's gone up about, I think it's about $23 or $24 currently. So if you're able to buy that at $1, and I think even some people at Intelligent Investor bought it in their personal portfolios at a lower price, but sold after it doubled, the stock has gone up about 25 times. So it just shows you the leverage in those performance fees, and that's why we often say funds management businesses are actually some of the best businesses you can buy, because you don't really need to add a lot of staff or increase your costs a great deal to manage a lot more money. So if Platinum was to go from today, say, around $23 billion of assets under management or funds under management, to go to managing $30 billion of funds under management, they wouldn't actually need to do anything. There wouldn't be any extra cost to add that money there, yet they'd be getting paid even more because the performance fees and the base fees are on that much higher amount of money. So it's more risky to buy the management stock than it is to buy a portfolio, but it also can mean much, much higher potential returns.
Okay, are the companies selected for both portfolios all covered in Intelligent Investor if we wish to find out more about why they have been selected?
Not every single one of the stocks is. The main difference tends to be right at the smaller end. So a company like Frontier Digital Ventures, which I wrote up for Intelligent Investor as well in their Christmas special report, and another small company I really like as well, which is in both the growth and income fund, which is called 360 Capital. I wrote that one up as well for that report. So you can see both of those, but it's really hard with the membership base at Intelligent Investor to buy some of those really small businesses, because it just has such an impact on the share price that only a couple of people can end up buying the stock. That said, I will talk to the boys about this, because I know it still is a problem, but I remember I upgraded a small company called Nanosonics, which if you've been following Intelligent Investor for a while, it's done really well. And I remember putting a long-term buy on it up to, I think it was 80 cents, and that's a $3.60 share price now. So it was a bit silly back then to think that you had to be so careful with the share price, and that and you're also worried about the small amount of liquidity in that business, when actually you could have paid twice that price or more and you still would have done really, really well. So it's actually a conversation that's been on my mind recently. So I will talk to the guys about it. But the bottom line is a lot of those smaller companies don't tend to be recommended by Intelligent Investor, but I do write up basically all the stocks in my quarterlies or monthly updates. Sometimes I don't write a lot about them, but when there's something important to write about or they're a new company, I tend to write a bit more about them. But there are some other differences. One example would be Reliance Worldwide, that I've definitely got in the growth portfolio, but doesn't pay a dividend, so it's hard to put a large helping of that in the income portfolio. But it's a company I think will do really well over the next 10 years. It's the number one market position in the US, in the UK, and Australia for these plumbing fitting suppliers called SharkBite. I'm not really sure why the guys don't like it, but I think it fits all the things I'm looking for. It's got insiders with their own money on the line in the business. It's got the number one market shares in businesses. It sells these little devices, which a family member was showing me over Christmas, which only cost about $6. And they're really, really functional. They're really, really important. And if you think of the cost of these little devices of fittings at $6, the pricing power you have with a small device like that, because if you think about the problems they're trying to fix, whether just, let's say, your plumbing busted and it was going to be a few $1,000s or maybe more to fix the plumbing, no one cares whether the device is the fitting is priced at $6 or $6.50. And if you're building a new house that costs maybe $1 million or $2 or $3 million, again, no one cares about these $6 fittings. So it's a bit like what Warren Buffett used to say about a can of Coca-Cola. You could put the price up every year by 1 or 2 cents and no one would care. Now, that's a great example of pricing power. So Reliance, to me, ticks all the boxes I like. and I'm not really sure why the boys don't cover it, but they obviously don't like it.
Okay, what stocks would you like to own now, but their share prices are just too expensive? What's on the watch list?
Yes, so this is a great question. You obviously know me well because I've always got a long watch list. There's actually a number of companies I really like, but I wouldn't say I was an expert on them yet either. I just probably haven't done as much detailed work as I would like to, but mainly that's because of the prices of where they are. But Xero is definitely up top on the shopping list. I may actually be being too conservative with this one, and I have it very high on my list to do more work on. If you're interested in Xero, the best piece of research I've seen anyone do on it by a mile was a guy called John Hempton. You can go to his website or just his blog called Bronte Capital, that's Bronte, and he actually made the case of how this business could potentially be 10 times more valuable in the future than what it is today, and he laid out basically what the business needs to do in the US to conquer the US market and potentially be valued like that. So Xero is one I've been talking a lot about with Alex at the moment. I haven't bought it as yet, but that's definitely high on the list. I haven't had a good look at WiseTech, mainly because the price to earnings ratio is just stratospheric. But the more I learn about the business, the more I like it. It's just got very sticky software that seems to be the best software in the business, and they've been in that industry a very long time and have very high renewal rates, just like Xero. And it's not just a software for today, but people keep talking about these things as their platforms, which is telling you that there's actually going to be, they'll offer more things in the future that they can charge money for. So it's a bit like what you really want straight up is not necessarily charge the most for your software. You just want people using it. And once they install it and then get used to using it, the switching costs become very high because people get used to using that software. It works. They don't want to change it. And therefore, you start to have pricing power over those clients. And over time, you can sell them more bells and whistles. So it's a really great business model. And I think I actually wrote in an article when I first got, or a question when I first got back in August. And I said, look, one of the things I'm really excited about coming back to is looking at some of these software businesses in Australia, because we've actually got a whole bunch of them and they are really, really good businesses. And sometimes they get sold down, and sometimes people just don't appreciate how big and how fast these businesses can grow, because they're not just Australian businesses anymore. They're actually globally dominant businesses. Like Xero is taking on the UK at the moment. It's got a pretty fierce competitor in Intuit in the US, which will be much tougher, but it dominates New Zealand and Australia. And when you see these businesses that can go global without having to spend a lot more money on the actual, I mean, all the additional money they spend is on marketing, essentially on salespeople. Like, that's a really, really good sticky business. And I think people often underestimate the compound earnings growth over 10 and 15 years. Just to give you a bit of an example, I got an old colleague a while back to look at what you could have paid on a price to book value ratio for Berkshire Hathaway back in 1960. And it was some crazy number, like you could have paid like 90 times price to book value. Which is just amazing. Now, obviously, you can't go and look at every company and expect 20% compound earnings growth for 4 or 5 decades. But the point is really important, that even when you say you're looking for quality, most people are looking for quality, but they're only looking at valuations for the next 1 or 2 and 3 years. So if you can start looking at what that valuation looks like over the next 5 to 10 years, and you're very confident about the business achieving something in that ballpark, then you can actually find that what looks like a really expensive price today turns out to be not very expensive at all. But there's a bunch of those software companies. I'd really like to add more to Pinnacle. I think that's a fund manager that's got a very good business, a very strong sales force, as Sophie here sitting next to me knows well. And I just know from my last employment, it's very hard to compete against them when they've got salespeople in every state. And as Sophie pointed out, so I might have to bring her on the analyst team, they said they've basically got a product for everyone. So they've got an income product in Plato, which I did some presentations with last year. They've got small cap. They've got very smart people beating their benchmarks in just about every category. And I think over time that could be a much bigger business than it is today. So I've got a very good watch list there. I'm very excited about it. And I may actually find, as I dig a bit deeper into some of these names, they might not be as expensive as what they look like.
Great, thanks, Nathan. Another question: who are the competitors to Class?
Yeah, that's a good question. The biggest competitor is a company, I think I've got the initials right, is BGL. And the problem that all analysts, including myself, have with this business is that it's not listed. It's a privately owned business. It's founder-led, so it actually ticks a lot of the same boxes as Class. but you can't actually look inside BGL and you can't really see what it's doing. But there are certain things that we do know about the business, and that is Class is having some. Essentially, BGL has been a little bit resurgent recently. They actually have invested in their business, and they've got a much better product than they did have, or at least a more competitive product, and that is putting pressure on prices, and we are seeing this at Class. So that's by far the biggest competitor. Class has a slide. If you just go to the ASX announcements and go to its last presentation deck, and we'll get another one soon for its updated interim result, and they always have this slide in there. They show whereabouts they're actually taking the market share from, and so they have BGL in there, and they talk about a couple of other big players like AMP, and so BGL is definitely the biggest competitor, but Class has been very good at taking customers from them. Now the question is what sort of market share can Class get to? Can it get to 40%, which would be great, or could it get to 50%, which would be incredible? My guess is it can certainly get to somewhere near 40% over time, because it still does have the best product, but it is going to get tougher from here because BGL has a more competitive product. But the big upside, the other part of it too, is just relying on more people who didn't used to use any software for their SMSFs. So people who just use Excel at home maybe, or just have a whole bunch of paper in files, we still need to get those people coming through from Class as well. So there should be natural growth from that over time. And the fact is, Class's prices are just so cheap, and you're talking, sometimes not even $100 for the product. Like, that's a really smart way to get people using Class and to get people off spreadsheets, and to get the average person at home willing to pay that sort of money, which isn't very much, to have a much better system. And what we really want to see over the next 5 years is those people using the portfolio product software, which is essentially the newer part of the business at Class. And I think at the moment, the number they quoted was 32% of all clients using Class SMSF software are using the portfolio software. So, and that's really what the theme I was trying to tell you about Xero and these platform software companies, is that once you get people using these software systems, you can find more bells and whistles to pay for. And so my investment case for Class is not just that the SMSF business will continue to tick along, which it needs to, but more over time that a lot more people are going to be on the portfolio software, and the company will be making fees from that.
Great, thanks Nathan. We have time for one more question. JB Hi-Fi has been one of the most shorted stocks for years. What is your view? The short sellers have been wrong for a long time.
It's a great point, and funny enough, I actually just had this phone call from a media outlet this morning, and I said exactly the same thing. It's been a short favourite, and if you look at the broader picture, it seems easy. They went into more white goods, which typically is low margin stuff, and a very, very competitive industry, particularly with Harvey Norman and Bingley and a bunch of others in that space. So that was a concern. Then Amazon came, and that was going to be a concern, but I think Amazon is still ramping up, so I don't think we've still seen the full force of Amazon yet. But the company just keeps ticking along, and part of that, I think, is that it's been able to adapt, and it's stuck to its knitting. It hasn't gone and invested more in its stores, or in the sense it hasn't tried to, a bit like Harvey Norman, it really sweats its stores, it keeps its costs low. I think that's really important. And what you see with these founder-led businesses is that if they do need to change, they can change quite easily. So while I was worried about the change to white goods, it doesn't seem to have hurt the business so far. And that's one of the things with 360 Capital, is that the business is investing at the debt level at the moment in property, which is the place at the moment you want to be, because it's got more covenants to protect your investment. But at the other end of the cycle, when everything's bombed out, you want to be in the equity to get the biggest bang for your buck. And only small businesses, or relatively small businesses, and particularly those with entrepreneurial founder operators, can tend to make those changes as easily. So I think that's a bit of the secret sauce at JB Hi-Fi. I think the outlook was just for flat earnings over the next 12 months. And a friend of mine I spoke to this morning thought that was a terrible outcome. But I thought in an environment where you've got property prices falling on average around 10%, if you had flat earnings growth after a good year of earnings growth from a business like that, I actually thought that would have been a pretty good outcome. I haven't bought it. Every time I go near retail, money gets lost. But the business has done a great job, so I don't own it. But I am actually in the process of buying a smaller retailer, and I'll talk about that next month.
Great. Okay, thanks, Nathan. I think that's all we have time for. Once again, a copy of the webinar and the slides will be available on the website shortly. Thank you.
Thanks, Sophie. I'll just add one more thing, just in terms of the communication at the moment. Alex, our small cap manager, and I are doing the weekly podcast. So if you've got any questions about specific stocks or even just the economy or anything, we're happy to take those questions and answer them. We've got a national roadshow coming up. We start in Canberra on Wednesday, so if you'd like to come along and you haven't got a ticket, please see the website and come along, because it's really great for me to talk to more of you and see how you're feeling about your investments. I don't often tend to hear a lot sitting there managing the portfolios, but one thing I've missed about not being an Intelligent Investor is actually talking to people and helping them with their investments and getting a sense of how they and their friends and family are feeling about their investments. And other than that, as always, I try to put a bit of effort into the monthlies and quarterlies. So keep up with them if you can, but if you get a bit tired, I promise I won't do any more 6,000 word quarterlies. It was just an exceptional situation where I had a lot to talk about, and I really wanted to get our process down in writing. So if any of your friends or family ever ask, why do you invest with Intelligent Investor and what is their process, you can easily point them to that. But thanks very much for listening, and our quarterly will be next quarterly webinar will be in 2 months from here. We just did it in February because we assume a lot of you would be away on Christmas break through January. So if I don't hear from you beforehand, look forward to the next one, and thanks again for listening.
Thank you.